It starts quietly. Your bank balance looks fine. Your retirement fund appears safe. You've been told your money is secure in bonds, blue-chip stocks, or bank deposits. Then a single headline flashes. Government bond yields plunge, biggest drop in 30 years. Within hours, millions of dollars vanish, not from fraud, not from reckless traders, but from math and timing. And you realize something unsettling. What you thought was safe isn't, not even close. For decades, people have been sold the idea of safe investments. Words like guaranteed, low risk, and stable are repeated so often that we stop questioning them. Banks, advisors, and financial news reinforce it constantly. Invest here, sleep easy. But in today's economy, these assurances are more fragile than they appear. Interest rates are unpredictable, inflation refuses to disappear, and algorithms now move markets faster than any human can. The rules that made certain investments safe in the past no longer apply in the same way. Let's break down why. Most safe investments are backed by governments or large corporations. Bonds, for example, promise you steady interest over time. Deposits in banks are insured up to a point. Stocks of major companies are considered reliable. For decades, this worked because inflation was low, interest rates were stable, and markets moved slowly enough for humans to adapt. But over the past 20 years, debt levels skyrocketed. Governments and corporations borrowed trillions. Low interest rates encouraged risk, and the assumption was that anyone, would always pay. Bonds and deposits only remain safe as long as the system supporting them stays intact, and that system is far from invincible. Now let's talk numbers, because this is where the illusion cracks. Imagine a 10-year government bond paying 3% annually. It sounds safe, predictable, boring even. But if inflation is running at 5%, your money is actually losing value every year. By the end of the 10 years, your $100,000 bond buys as much as $81,000 today. Even worse, rising interest rates cause bond prices to fall. If you sell before maturity, you take a loss. Bank deposits and so-called risk-free funds face similar hidden dangers in a system-wide crisis. On paper, your money seems secure. In reality, it's quietly eroding. There's also a stark contrast between perception and reality. Your financial advisor may reassure you, this is safe, guaranteed. You nod, trusting their expertise, and go about your day. Meanwhile, unseen forces, market shifts, policy changes, algorithmic trading can trigger cascading losses in ways no individual can predict. The very instruments marketed as safe can become unstable during moments of stress, precisely when everyone wants them to remain solid. And the irony? People cling to these so-called safe investments most during crises, which is exactly when the system is most fragile. Step back, and the bigger picture becomes even more concerning. Trillions of dollars are parked in instruments designed to be secure. Yet all it takes is a combination of rising interest rates, persistent inflation, or a small market shock, and the illusion shatters. Entire retirement plans can quietly lose value. Governments might struggle to pay debt. Even institutions deemed too big to fail can wobble. Safety in finance isn't about guarantees, it's about assumptions, and assumptions can fail, sometimes spectacularly. It gets more personal when you consider the human element. Risk isn't always obvious. It hides in compounding, timing, and invisible connections between markets around the globe. You might think your portfolio is protected because you've diversified or chosen safe instruments, but the same investments that appear steady in calm markets can behave unpredictably when conditions change. The danger is subtle, almost invisible until it hits, and when it does, it often comes too quickly to react. So, are any investments truly safe? The honest answer is, safety is relative. It depends on timing, context, and the underlying stability of the system, which is far from guaranteed. Next time someone tells you something is guaranteed or risk-free, ask yourself, guaranteed by whom, under what circumstances, and against what risks? Because in finance, the truth is rarely simple. Safety is assumed, not given, and assumptions can be dangerous. The real question isn't just how much you can earn, but how much you're willing to trust a system that can quietly erode your wealth without warning.